When economic recoveries begin to take shape, they bring both opportunity and uncertainty to the Forex market. This phase of the economic cycle often follows a downturn, and while optimism starts to return, volatility usually stays high. For Forex traders, understanding how to navigate this transition is crucial to making smart, profitable decisions. So let's break down some of the best approaches to trading during these recovery periods. One of the first things to recognize is that recoveries don't happen overnight. They often come with mixed economic data. You might see rising GDP alongside persistent unemployment or cautious central bank policies. That's why it's important to anchor your trading strategy to a reliable analysis framework, starting with fundamentals. Watch closely for shifts in interest rates, inflation numbers, and especially employment reports. These are often the first indicators that a country is stabilizing and potentially strengthening its currency. Another powerful tool during recoveries is the use of currency strength analysis. Rather than just focusing on single currency pairs, look at the bigger picture. Ask yourself, which currencies are consistently gaining strength across the board and which ones are lagging? Pairing a strong currency with a weak one, like going long on USD/JPY, if the US shows strong job numbers while Japan's economy remains stagnant, can be a high probability move. Market sentiment also plays a massive role. During recoveries, traders tend to flip between risk-on and risk-off modes. Keep an eye on equity markets, commodity prices, and overall investor sentiment. When optimism returns, riskier currencies like AUD and NZD tend to benefit. In contrast, if sentiment suddenly sours due to a poor economic report or geopolitical shock, traders often rush to safe havens like the USD or JPY. Timing your trades around these sentiment shifts can make a huge difference in performance. Now, let's talk about risk management, because even during a recovery, things can go sideways. Economic data can be revised, policies can change, and global shocks are never out of the question. That's why you need to be smart with your trade size, stops, and exit strategies. Use trailing stops to lock in profits as the market moves in your favor. And don't be afraid to take partial profits when appropriate. This is where a tool like the TakePropips Trading Management Solutions EA can quietly elevate your game. It gives you full control over trailing stops, break-even settings, and partial closes, so you can react to market changes without being glued to the screen. Plus, its currency strength meter and trend scanner are especially useful during recovery phases when trends are forming, but not always clear. Economic recoveries also favor adaptive strategies. What worked in a downturn might not work as well during a rebound. Consider shifting toward trend-following strategies as momentum builds. The trend breakout, or profit ladders approach, for example, can help you capitalize on persistent directional moves that often accompany recoveries. Just make sure you're using strategies that match the current phase of the recovery, not what the market was doing 2 months ago. Lastly, patience pays off. Recoveries are full of fake-outs and sudden reversals. Use a dashboard or trading assistant that allows you to filter trade setups based on success rates or technical confluence. Waiting for high probability trades backed by solid fundamentals and confirmed by technicals can make all the difference. So if you're trading during an economic recovery, focus on fundamentals, monitor currency strength and sentiment. Adjust your risk dynamically and use tools that help automate smart decisions. The Forex market doesn't reward random risk, it rewards preparation, strategy, and adaptability. And if you're looking for a reliable system to help you manage all of this with precision and efficiency, the Trading Management Solutions EA by TakePropips is worth checking out. It's not just about executing trades, it's about managing them like a pro, especially when every pip matters during the uncertain but opportunity-filled recovery phase.